countries like China show some of the scarier scenarios for how that can turn out, where they can link like a social credit score, for example, to your money and just basically try to control society at a much finer degree than we've normally been used to. So I think we've had a multi-decade trend towards greater and greater financial surveillance and control, and central bank digital currencies kind of represent the end game scenario for that. I'm generally not positive on CBDCs, even though I can see why in some cases they're interested in using them. And what I'd rather focus on is building some of these open source alternatives, right? So my base case is that the 2020s decade will not be a good one for equities, especially in inflation adjusted terms. Um, it's not necessarily that I'm expecting crashes, although I mean they're certainly possible. It's more like when we're looking back from the late 2020s or we're looking back from 2030, I just think it's not going to be a very good decade. And of course, how volatile it is will partially depend on all sorts of policymaker decisions. But if we zoom out, ever since the 1980s, we've had this period of lower interest rates and higher equity valuations. And because if you're comparing how much you pay for an equity to a 10% yielding treasury bond, right? You're not willing to pay much for that equity because you're taking on a lot of risk and volatility, and you can get a 10% yield on the treasury. So you're going to pay a very low multiple for that equity. You're going to get a very high, say, dividend yield, earnings yield, in order to compensate for that risk. But when the treasuries came down all the way to like sub 1%, people were willing to pay almost anything for an equity. Because it's still, has better forward return prospects than a super low yielding treasury. But now that we're kind of in a regime where treasuries and interest rates have really hit the floor, and now they're in this more sideways to up type of environment, that takes out, I think, that tailwind of ever higher equity valuations. And so they're more going to trade in line with their earnings. And so I certainly think you can see a period where, especially in inflation adjusted terms, the major large cap indices just kind of chop around in a band for 5+ years, which is quite common, unfortunately, among global equity markets. The U.S. has been kind of an exception for the past 40 years. We've had among the strongest markets, but I think that trend is probably over, and now we're looking at more. It depends on the stock you're in, depends on the sector you're in, but I think that the big indices are not in great shape. And another factor is that you can look at all these valuation metrics, but one of my favorite ones is to look at household allocation to different types of assets. And when the stock market peaked in late 2021, US households had a record percentage of their assets in equities. And so there really wasn't a lot of marginal capital available to come in. And then when you look globally, countries had basically, both investors in the US and investors outside of the US were kind of like max overweight the US. And so we really have all got on one side of the boat. And so I think now that has some degree of time to unwind. And that's part of my thesis on why we're not going to probably see good equity returns in the US for the next 5+ years. Economic deceleration, and borderline recessionary conditions in a number of metrics. And so I think the yield curve is, accurately forecasting problems. And, for a while, the 2-year yield was ahead of, say, the Fed funds rate. But now the 2-year yield has rolled below the Fed funds rate. But, and if you look at also, obviously, like, euro dollar futures and things like that, the market is now pricing in a more dovish Fed than the Fed themselves are indicating. And so I think overall, the bond market, the rates markets are, fully aware of some of these recessionary risks and probabilities ahead of us. So the Federal Reserve is letting bonds mature off their balance sheet, and they've been doing that since early 2022. For before then, there was just a slowdown in how much quantitative easing they were doing, by late 2021. And then as they entered 2022, they were outright doing quantitative tightening. And the way that works is that basically if bonds are leaving their balance sheet, not because they're selling them, but because they're maturing them and then they're not reinvesting them, it means somewhere else in the system, someone has to buy those bonds. And that happens generally with bank deposits. And, when you have QE or QT, and it's mostly buying or selling things to banks, you generally don't get a big difference in broad money, things like deposits. But if non-banks are the ones that are, having to get rid of their deposits and buy those securities, then you actually have a net contraction in the number of total deposits in the system. And so really a lot of that is Fed activity. Now around the margins, you also have money markets and things like that due to the rate differential that the Fed has created. But a lot of the outright contraction you've seen in deposits has been from this kind of year plus of quantitative tightening. A big thing I'm focusing on is money through a technologically driven lens. And so, as technology changes over time, it changes what is suitable for money. And so, for example, with the introduction of telecommunication systems in the second half of the 1800s, that gave bank ledgers a big advantage over gold because if you wanted to do any sort of global commerce, being linked into this global system was more attractive compared to, owning physical gold. But of course, the problem was then banks and governments could abuse that. Basically, you had a big difference in terms of transaction speed and settlement speed, and they could arbitrage that difference. And really, the entire banking system as we know it, the modern version of it, has been constructed on this premise that transaction speeds and settlement speeds are different. And both in fiat currencies, we've seen an acceleration of settlement speeds. And so basically with software APIs and social media, bank runs can happen far more quickly, including on a nationwide basis than they could back then. In many cases, their government or their central bank be the liability. Because if you have money in a bank, you're trusting that particular institution to remain solvent. Part of the reason people are flocking towards T-bills and money markets is because you have better counterparties. You have the Treasury, or you have the Federal Reserve, providing reverse repos, which is most of what's making up money markets these days. And so there's a lot of interest in having those kind of larger centralized counterparties for people. So that's one reason. Also, in many countries, you have low banking access because it's not profitable for banks to bank them. And so a government could choose to have that be a loss leader and say, well, we're going to be willing to provide basic banking services to everyone, even if it's not profitable on a per customer basis. So those are kind of the pros of it. Um, Obviously, the downsides is that when you centralize everyone's usage of the public ledger, that gives the government extraordinary control. They can surveil everything. They can freeze funds more easily. They can make it more programmable. So they can say, interest rates vary based on your age or based on, other activity. Um, I think countries like China show some of the scarier scenarios for how that can turn out, where they can link like a social credit score, for example, to your money and just basically try to control society at a much finer degree than we've normally been used to. So I think we've had a multi-decade trend towards greater and greater financial surveillance and control, and central bank digital currencies kind of represent the end game scenario for that.